Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. Josh, what's the latest this week?
Yeah, Steve, what's the latest these days other than baby stuff? Because we could be coming out anytime soon. Lots going on across the business. We've obviously got the other podcast now running, Link Wealth Finance, the boys over there in what we call the Brokers Lounge. Eddie and Carlo doing a really good job on their podcast. Hopefully they will maybe overtake us and we might link up and do a joint podcast at some point in time. But of course, yeah, everyone that's listening on ours, definitely get over and listen to the Brokers Lounge because it's looking at everything from the different sort of perspective in the mortgage and lending world, and there's obviously a lot happening in that space at the moment with interest rates talks of coming down in a not too distant future, and a lot of the lenders are starting to go early and move their fixed rates and so on as well. So there's lots of action on that front. And then I guess, for us as well, we've got back from the US a couple of weeks ago and we're, looking at some expansion and global. We're, going over to Singapore and going to have a little bit of a look at what's happening over there. And that's not just related to the topic we're talking about today, which is talking about more tax structures, looking at individual and company name. But Singapore also is a very low tax environment. And that's why a lot of, Australian companies do, or Australians actually go over there. And I've had some clients that have worked over there for many years and then end up coming back to Australia as well. So on all fronts, Steve, there's plenty happening. But what about for you?
Yeah, it's exciting. I think going global is going to be exciting. We've already got an international company. We've got a company in the Philippines, Lavera, which provides back office support and administration for us and other financial services businesses. So natural progression for us, I think, to look at other regions and wealth advice and see what we can do out there. But business as usual for me, mate. I've had lots of work to do this week from the business perspective. Not a lot of time for myself, but that's okay. That's what I signed up for, the usual. And if we get into this week's topic, mate, we talk about tax a lot, and on this podcast we talk about family trusts and ins and outs. But today in particular is about individual v company. Yeah. And we kick that off and start with individuals and tax and how that gets factored in, the reason, the why, and we often give advice on individual investment for tax purposes. But let's kick that off.
Yeah, so I guess, if we're talking individual for tax purposes or investment purposes, it's really the easiest way you can go. There's no setup. It's just, open an investment in your name or an account in your name, simple and easy. Accountant doesn't need to get involved. Buying a property in your own name, simple and easy. There's no structure or anything that needs to be set up, but just because it's easy doesn't necessarily mean it's right. But if we're looking at the benefits of it, well, there's no extra admin, it's low cost, and probably for most Australians, I don't know what exact percentage, but a majority of Australians, just individual names fine generally. Just investing in the individual name, earning average incomes for your average Australian family. There's nothing wrong with going in your individual name, particularly if you don't have any business exposure or there's no asset protection concerns or anything of sorts there. So it's simple, easy, low cost. You keep the 50% capital gains tax exemption if you've owned assets for over 12 months. That's always one to be noting, because in some of the other structures that we'll talk about, like the company, that doesn't exist. The tax rates is very sort of flexible in a way, but flexible is probably not the right word, but it's very open. So you've got from 0 all the way through to 45%, then plus the Medicare levy on top of that. So nearly 47% highest rate of tax you could be paying in Australia if you are earning over $190,000. But it's on a tiered scale as well. So you don't just, if you're earning $190,000, you don't get taxed all of your income on the highest tax bracket of 45% plus the Medicare levy. It goes up through each of the different sort of tax rates. So you start 0 to 18,200. There's no tax whatsoever on that. And then you go up to the next bracket, and so on until you eventually get to earning over $190,000. And then it's only on every dollar over $190,000 that will be taxed at 45% plus Medicare levy. So a lot of people get confused on that. Like I hear so often, like, I don't want to creep up into the next tax bracket because now I'm going to go from paying 30%, 37%. Like I hear that so often. It's not how it works. It's only every dollar you earn in the new tax bracket. Another one with that, a lot of individuals get confused of having second jobs.
Why do you reckon it's so confusing? That comes up a lot, and it's why do you think it is?
It's obviously goes to the system and the education system. Like in my school, I didn't learn anything on general finances. Like there was nothing taught on it, and it's a more of an old school mentality, and that's probably where I see a lot of that. And people that don't really educate themselves, like they just get what they're told from their parents or people that they're around who might not have the right mindset or knowledge in the first place, but then that sort of feeds and washes onto them. But I think that would be getting a lot better, and that's probably through some of the work that not just us, but there's a lot of people out there on TikTok and social media these days, preaching financial literacy and talking about tax and all these bits and pieces. So I definitely think people are going to be getting more aware naturally just through that, because the access to technology and information these days, it's like just everywhere. Whereas in the past, you probably didn't have that to the same extent. And that's maybe why there was so many, a lot of misconceptions and people not really understanding around these basic things you would think that are quite basic, but still people don't truly understand how they work. But the tax rates will vary individual name, but the biggest cons there is like, there is no flexibility when it comes to investments when it's in your name. So once the investment's in your name, like that's it. It's all going to be taxed at your tax rate. So your employment income will be grouped in there. Your investment income, rental return, whatever it may be, all of that's just grouped together, and then you'll be taxed based on however much you've earned. And there's no flexibility around getting out of that. Of course, your accountant can maximize your deductions. The property might be negatively geared, but that's it. There's no flexibility there. And of course, the big one is you don't have any asset protection. So if you're in business or someone comes after you or is able to sue you for whatever reason, if those assets are in your own individual name, there's a potential that they could be taken away or accessed, which is a major downside of having assets in your own individual name, and commonly why business owners don't generally utilize that structure. But what if I throw back to you, Steve, on company structure? What's some of the differences there with the company structure and tax rates, etc. there?
So yeah, company structure is like brand new entity, highly used for business owners, obviously for a variety of reasons. But if we're talking about investment purposes, then you can pay up to 30% tax on the earnings, which can be favourable. It's not, you can get lower tax rates on an individual, but if you are in a high income bracket, clearly instead of paying nearly 50% of your money in tax, you're only paying 30%. So it does have its benefits. However, you need a good accountant involved here, because there's lots of dividend loans and distribution issues that come about, because at some stage they need to be distributed, and it's franking credits get involved and the like. So you do need some good accounting advice when we start investing through a company. But clearly that tax rate of nearly a 20% gap between the high marginal tax rates of an individual versus a company can be very, very beneficial. So that's the starting point, I suppose. That's why we invest through companies if we're going to talk about the investment purposes. Business is different. In general, you always set up a company to run a business, asset protection, employee structures, or whatever it may be. I suppose the other benefit of it all, as you alluded to before, is asset protection. It's not in your name. That can also be beneficial from an asset protection point of view. But clearly but again, as you said, the CGT discounts and things like that are not the same when you're investing through a company as an individual. So you've really got to weigh it up, I reckon. And I must say this, that when we give advice around all this stuff, and we spoke about trust before, so I won't talk too much about trust, but generally it's a combination of all of these. Like generally you want to max out your individual name for that zero tax rate. I think it's up to $18,200 you can earn per year as an individual. So clearly we want to do that, right? If someone's not making much money, say you've got a partner that's not really earning money, well, that may be a good spot to start investing under the partner's name, because they're going to pay zero tax until they earn, $18,000 or just over. But then it's probably, okay, what's next? So then it's, okay, once we tap out of the individual framework, company structures, trust structures, or company within trust structures, I should say, starts to kick into gear. So that's probably the setup. But generally when we give advice, it's everything, right? It's bits and pieces of everything, really.
Yeah, and I think it's a good point you mentioned. Like a lot of people miss that like your small business, your average small business only pays tax at 25%. But if you open just a company to invest, it does pay tax at the high tax rate for businesses, which is 30%, which is normally only around for companies when you're trading over 50 million. So it's definitely worthy of noting, because sometimes we do see and talk about with clients having a company set up through their family trust as a beneficiary, and that doesn't actually get the 25% tax rate.
Yeah.
That's taxed at 30%. It's not actually a trading company. It's just for essentially investment purposes. But yeah, you really hit on all the points there. I guess it's just with that structure, you just have the flexibility when you have a company, like when you're, I guess it's business and investments different, but you just have more flexibility around how you're paying yourself and how the money moves, because you don't have to pay the money out year on year. If you're running a company, you could actually just retain all of the profits year to year in the company. So whereas if you're in an individual name, say you're getting 50 grand of income, you've got a lot of investments, passive income from shares or property or whatever it may be. If that's in your individual name, that's lumped onto your tax return year on year. You can't stop that. Whereas if you've got the company and then there's still you as an individual, which is separate, if you had, say, 50 grand of profit or investments through your company or whatever it may be, you don't actually have to distribute it out to you as an individual. You could retain that in the company and just pay the corporate tax rate, and then look at distributing it out at a later year, maybe when your personal income or your income is actually lower. So you can get a bit sort of nimble and flexible around that. But then that's where you get into the world of franking credits, of course, which is quite an confusing topic for a lot of people. And I've had some accountants in the past that just couldn't actually explain to me how franking credits truly work. But it's quite simple when you think of, if the company that you have is paying tax at 25% on all of those profits, and then you wanted to distribute those profits out to yourself as an individual, the ATO or our system works in a way that you won't be taxed twice on that. So if the company's already paid 25% tax on the profit, when that money comes out to you by way of what we call a dividend, it will come with that franking credit, which is just representing the 25% tax, or the tax that's already been paid by the company. And then that basically will help offset how much tax you end up paying, which is essentially just the difference of if you're in the highest tax bracket of that, say 47% with the Medicare levy, and the company's already paid 25% tax, you pay something called top-up tax. It's not a new tax, but it's literally just the difference between the company tax rate of 25% and whatever your marginal tax rate is. So if it's 47%, you're going to pay the differences, that 22% differential when that money comes out to you through the company. So you just have way more flexibility, essentially, with that company.
And clearly then it's timing comes into it, right? Like as advisors, we do a lot of work around timing and when to distribute, when to sell, etc., because people's incomes changes, right? So across the year, so if there's a year you might not be working, well, that's a good time to sell because low incomes, and so timing those distributions and pay, that's an ongoing process we go through, especially for us, and I think that's got to be mentioned because it's key to managing finances is about managing the ups and downs as you ride through the journey, and that can be a big part of when to pull the trigger.
Definitely. And you mentioned asset protection before, and I think it's also worth then noting for people that if you a director of a company, if something happens to that company, they can go after you. Like generally the directors are like guaranteeing, loans and things like that within the business, like we do. And therefore, if something ever happens to, say, we talk about Link as an example, if we've got assets in our own individual name, they could be accessed. So even though the company is a separate entity, if something happened with that company and ultimately the company can't pay up, it's usually the directors that are guaranteeing and on the hook for absolutely everything. So even though you've got a company, you still got to be careful of what assets you do have in your individual name just for that reason. And that's why we've said, I think, a few times on the podcast, it's why a lot of people won't have their family home in their own individual name. If they run a company, they typically would just put it in their spouse's name, which is actually quite easy to do when it's a family home. But this just talks more to the importance of planning, because if you've got other properties and things like that you've built up and they're already in your individual name, unwinding that and getting those transferred over is not cheap. So that's where we always harp on about getting the structuring and planning right from the absolute get-go.
Yeah, and then if we move on to sort of, we've spoken about this a couple of times, but SMSF's probably not so much trust, but like, when's the time for a self-managed super fund compared to investing in company, compared to investing in self, and how do you balance all that out?
Yeah, I don't know. If I look at my own journey, so if I reflect, like I started out individual name, so early 20s, late teens, started my investment journey, and just like a lot of people, you just start in your individual name. It's cheap, low cost, wasn't earning much money, and then went from there. And then I started thinking, right, well, I'm starting to earn a lot of money as an individual when I was an employee, and I couldn't do anything about tax and being savvy there. But then there was my partner Alana, who wasn't earning as much money. So then I actually changed tack, and I'm like, all right, I'm going to start investing in her name. So we started doing all of our investments through her name. But then we got to a point and we're like, all right, now I'm getting involved in business. Shit, now we've got to look at another structure. And that's when then the family trust come into the mix. And that's then basically how we do all of our investments moving forwards. And then through that, and I sometimes speak to clients about this, like, sometimes I say to clients, like, I want you to prove to me in a way that you're going to be able to invest at the rate that's going to be beneficial to utilize, say, a family trust, because a family trust could be a good option, but if you're not going to be investing enough through it, it may not be the right option for the future. So, it's nothing wrong with starting, maybe doing a little bit of investment in your own individual name to begin. And then, you're 1 or 2 years down the line, whatever you've invested, maybe 50 grand or 100 grand, whatever it may be, unwinding that, or just starting to do all the new investment through another structure like a trust, and then slowly transfer that down or sell that down when the timing's right and get that into the trust. There's absolutely nothing wrong with that. So starting in your own individual name, there's nothing wrong with it. And then, looking at the different entities. But of course, if you're setting up a business, like we said on the last podcast, if you go sole trader, generally not the way to go. Like, you just set up the company, get the structuring right, from the get-go. It's going to cost you a couple of $1,000s a year.
Yeah.
Like, if you're not turning that over, and that's an issue, like, I don't know if the business is the right sort of journey. I guess side hustles are a little bit different. If you got a little side hustle, maybe that's a bit different. Like, I had a little gardening business once upon a time that turned over like 15 grand. It's probably a little bit different. I don't want to pay, an accountant $2,500 a year to manage that thing for me. So, that's going to be a little bit different, but it's always about thinking forward, structuring right from the get-go, and it's no cookie cutter right solution for absolutely everyone, but you do need to think about it, because, I've seen multiple situations. People have built up assets. You want to start now transferring them into trust. Like, everyone's like, can I get all these properties now into trust? And it's like, well, no, you can't. You're selling them. You're paying capital gains tax. The trust is going to pay stamp duty when you acquire it. So it's like, we've got to think about these things from the get-go, maybe pay a little bit more money up front to get the right advice, get the right structuring. But then when you're cruising down the line 10, 15 years, when these investments have doubled, or they're, super profitable and producing a lot of income, well, then you're loving yourself when you've done the structuring right from the get-go, but incredibly expensive to unwind. But what about you, Steve? When you have clients walk in and, they want the whole kit and caboodle, and they want all these fancy entities, what are you doing?
Yeah, well, keep it simple. All these fancy stuff sounds great, but often you don't need to make it too complicated. And a lot of times it can be very easy structures, but different structures, and just maximize your low tax environments, wherever that may be. So people all have different situations, and we've only got about 5 different entities we can use, really, for a variety of reasons. There's not millions of them, there's 5.
Yep.
And so it's a balancing act between all those 5. For anyone with a bit of cash, it's probably all 3 or 4 or 5 of them in the mix at all times. And then it's just managing them, right? So managing the inflows, outflows, sales, and that's part of the annual reviews we do, is just managing that process to maximize that tax-effective investing. So there's tax-effective investing in entities, and then getting the investments right, and putting those 2 worlds together. And that's the job. So, but it shouldn't be complicated. This stuff, clients walk in, our job is to educate just as much as set up. And so we educate our clients on terms of how this all works and feels. We want them walking back at the door very clear on the strategy, very clear, very transparent. They know exactly what they need to do, and that's a good result. If they're walking out the doors and they're not sure, geez, what structure we're using or how this works, well, we haven't done our job properly. I think anyone that overcomplicates this is crazy. It doesn't need to be complicated. So we just got to educate, keep it simple, but then manage hard. It's not a set and forget like anything in Australia. We've got a very complex regulatory environment, very complex tax system behind the scenes. The all ins and outs of it, can be quite complicated, but the structure of it is quite simple. So we've just got to keep it that way, and just maximize the returns. Because if you don't, and one of the points here was what happens if we get it wrong, the wrong structure. Well, unfortunately, in Australia and a lot of the Western countries around the world, if you get it wrong, you're giving away half your money to the government. So it may be all of it, right? So, you just can't get it wrong. You just can't get it wrong, because the downside is so down that it's not even worth investing. You may as well just not even bother. So you've got to get this right, especially if you're buying big assets like properties, or if you're going to end up with a lot of wealth in the millions. Well, you don't want to give half of it away. So I'd say that just get we've got a super expensive tax system here in Australia, so we've got to get this right. Making 10% is great, but if you've got to give away 50% of your money, well, what's the point making 10%?
Yeah, no, it's a good point, and a few good points you mentioned. Like the maintenance is a big one. Like, you attend to your garden in your house and all those things. You maintain them, your car and so on. But if you're not maintaining your finances and all your structures, which is why a lot of clients work with us on an ongoing basis as well, to keep on top of this stuff, because government's always tinkering with rules and regulation and always will into the future, which keeps us busy. But if you're not optimizing that year to year, it can cost you heaps over the longer term. And I've got some clients I'm working with at the moment. And you have to be careful out there as well, because there are a lot of people and gurus that, preach this stuff. And I've got a client I'm working with at the moment who's got so many entities set up. It's not funny. Wow. And the reason why they've got all the entities set up is because they attended some seminars and things like that, where they were told they had to have all these different structures. And we're looking at doing more structures. And I'm talking there would be 5 or 6 entities involved here for someone who shouldn't be doing this stuff at all. And there was still more structures looking to be set up. And like, it's just, it's a very easy sales gimmick, I think. Like having a family trust and all these entities, it probably sounds cool. Like, to my friends, it's like, cool. Yeah, I've got a trust and all this sort of thing. It's like, great. But, it's probably not doing you much of a benefit. No, so you got to be very careful of that. And every now and then definitely see some people that, could definitely benefit from doing all of this, but they also don't want to just spend some of the dollars initially. And I don't know, Steve, have you had some clients before where, I know at the higher end of town, they're earning good money, got good assets, but they don't want to sort of pay for some of the advice, and then therefore they're just like leaving money on the table?
Oh, unfortunately, yes. And probably more than I'd like to see. Even I say to clients, if they don't want to deal with me, well, go deal with someone else that you want to, if you don't want to deal with me, but just get it done. Yeah. Like you're talking for the sake of spending 5, 10 grand, 15 grand or whatever it is on getting the right setups and the right advice. They're putting on the table that they're going to lose hundreds of thousands of dollars, And it's just, okay, go on, let's work this out here. I'll show you the figures of what you could lose. If you want to use me, great. If you want to use someone else, use Josh Lee, fine. Like whatever. But just get it done. Like for the sake of stop being tight. Because that's going to bury you. You're going to make a huge mistake here, and I have seen it. Sometimes you just can't convince them.
Can only do what we can do, I guess.
Help so many. So.
And that's like, with clients that work with us, obviously we're not free. Like we charge fees for the work that we do. And every client that I speak with, like I say, look, if you're going to be investing to get a financial plan done, like you're investing in your future is what you're doing. And then of course, if you're making that investment, well, you probably want to know what's your payback going to be, like what's your return going to be. And nearly in every situation of client that we're working with, like whatever they're investing, if it's a simple plan to something more complex, the return over 5, 10, 15 years is generally huge. Like 10, 20, 30, 40, 50 times what their investment is going to be, like hundreds of thousands or millions of dollars of difference over, 10 to 15 years. And it's like, all right, would you pay 5, 10 or 15 grand to make $1 million in 10, 15 years, nearly guaranteed? Probably. But of course, not everyone wants to do that. So I think we've covered off a lot in today's discussion, Steve, and we might call it from there. Guys, if you're getting value out of it, 5 stars, Spotify and Apple as always, because it helps us out a lot. If you want to chat with any of the advisors, you can check out all the social media channels, and you can actually go through their social media channels to have a chat with any of the advisors. Steve's newsletter does go out every single week as well, where we are covering different topics. And then you can always jump on the website if you do want to just book directly into the advisor's calendar to chat about your own personal situation. And as I said at the beginning, hop on and have a look at the Brokers Lounge podcast, because they're putting out some good content on that side of things as well. And until next time, Steve, I'll see you then, mate.
See you then, mate. Bye.
Catch up.